Hey everyone, welcome back to Corporate Decoder, the place where we crack open the finances of public companies. Today we're diving into Yoshiharu Global's latest quarterly report, and it looks like things have been quite the roller coaster for this ramen giant. This is their quarterly report for the period ending June 30, 2025, and it covers a lot of ground from their financial health to their expansion plans. First off, let's quickly touch on their stock situation. They've got Class A and Class B shares, and they had a big chunk of Class A shares outstanding, around 14 million, and just 100,000 Class B shares outstanding as of August 17, 2025. Now let's get to the juicy part, the financials. We're looking at their balance sheet comparing June 30, 2025 to December 31, 2024. Their cash position has seen a slight increase from about $1.2 million to $1.3 million. Not a massive jump, but it's good to see cash on hand. This is interesting. They now have a loan receivable from a related party for $1.4 million, which wasn't there at the end of last year. This suggests money is flowing between the company and its insiders. Overall, total assets also grew from 17.5 million to 19 million, which is a positive sign of company growth. On the liability side, accounts payable and accrued expenses went up from 843,000 to 967,000. Always something to keep an eye on as it shows their short-term obligations. A big change here is the convertible notes to a related party. Last year they owed $1.2 million and this year it's zero. They've paid that off. This is a significant debt that's been cleared. Overall, total liabilities, however, decreased from a hefty 17.3 million down to 14.3 million, which is a good improvement, showing they've managed to reduce their debt burden. And now for the stockholders' equity. Their accumulated deficit, which is basically their total past losses, increased from 12 million to 14.6 million. This means despite paying off some debt, they are still losing money overall. Despite a larger deficit, their total stockholders' equity actually shot up from 255,000 to almost 4.7 million. This is largely because of a huge increase in additional paid-in capital and also a warrant subscription receivable, which suggests they've been selling a lot of stock and warrants to raise cash. Now, let's look at how they're doing business-wise. This is their statement of how much money they made and spent. For the 6 months ending June 30, 2025, their total revenue was $7.2 million, up from $6.1 million in the same period last year. That's a 17% increase, which sounds great. But here's where things get a little concerning. Their cost of food, beverages, and supplies jumped by over 50% from 1.5 million to 2.3 million. This is growing much faster than their revenue. This jump means that for every dollar they earned, they spent a lot more on ingredients. This is a classic sign of rising costs eating into profits. This led to their net restaurant operating income turning into a loss of $316,000 from a profit of $447,000 last year. They are now losing money on the direct operations of their restaurants. When you add in all their other operating expenses like general administrative costs, their total loss from operations actually worsened significantly. It more than doubled from $1.7 million last year to almost $3 million this year. They did have a big jump in other income from just $12,000 to over $800,000. This might be from interest earned or maybe some other one-off income, but it wasn't enough to cover the increased operating losses, and that brought their total net loss for the 6 months to a significant $2.6 million. That's a big increase from the $19 million loss they had last year. Let's check out their cash flow statement to see how they're managing their cash specifically. For the 6 months ended June 30th, 2025, their cash used in operating activities was a huge $4.5 million. This is a massive worsening from the previous year when they actually generated $621,000 in cash from operations. This $5.1 million drop essentially means they spent way more cash to run the business than they brought in. A big part of this was the increasing losses and also changes in how they manage their short-term assets and liabilities. In investing activities, they spent $1.8 million acquiring entities in Las Vegas last year. This year, they spent much less on investing activities, almost nothing in comparison. On the financing side, they brought in a much larger amount of cash from selling shares and warrants, which was $6.4 million in 2025, compared to very little last year. This is likely how they funded their operations, given that operating cash was negative. Now, let's talk about some important developments and risks. This is a really positive development. Last year, they were at risk of being delisted from Nasdaq because their stock value was too low. But in March, they got a notice saying they were back in compliance, which means they're still listed on Nasdaq, thanks to some very recent stock activity. They also mentioned some internal control issues. They have material weaknesses in their accounting department, meaning their internal controls weren't fully effective. They've hired more staff and consultants to fix this, but it's an ongoing process and something to watch. Looking at their growth strategy, they're planning to open a lot more restaurants, aiming for over 100% annual unit growth. They also want to increase sales at existing restaurants and are even thinking about selling instant ramen. Their core mission is to make their authentic Japanese ramen accessible to everyone, and they believe their quality ingredients and slow cooked broth are key to that. And an important update after the period covered by this report is a planned 4-for-1 stock split. This doesn't actually change the company's value, it just means each share is divided into 4, making the stock price per share lower. They also announced a potential name change to Vestant Inc., reflecting a shift into real estate and digital assets. So what's my take on all this? Yoshiharu Global is definitely in a growth phase. They're expanding, opening new stores, and raising a lot of cash from selling shares to fund this. The positive news about staying listed on Nasdaq and paying off debt is good. However, the increasing losses, particularly the negative cash flow from operations and the significantly higher cost of goods sold compared to revenue, are major red flags. It suggests they're spending a lot to grow, but not efficiently enough yet to turn a profit on their core business. The big jump in other income helped, but relying on that is not a sustainable strategy. The company is trying to grow fast, but it's costing them a lot. And right now, the operational side isn't making money. They need to figure out how to control those rising food costs and labor expenses to actually become profitable. The shift into real estate and digital assets also indicates they might be looking for new revenue streams beyond just ramen. It's a company with big ambitions, but it's facing some tough challenges in its current operations. They're in a growth phase that's burning through cash, and the core business isn't covering its own costs yet. Alright, that's our breakdown of Yoshiharu Global's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.